Everybody that's here and everybody that may be
Recording
watching.
in progress.
Perfect. Hi. I'd like to welcome everybody here to a workshop, as we're referring to it. It is not a formal town council business meeting. It is our first public workshop being telecast on CMC's YouTube channel and their Facebook page, as well as our Town of Sykesville Facebook page. I'm not sure, at some point, maybe we could, I guess if anyone would like to speak here at the table at any time, maybe introduce yourselves before doing so for the public's sake. But in the meantime, we're here this evening to get an update from the Warfield Development Company and with respect to the Workfield development on the east side of 32. And thank you for coming, you guys. We appreciate it. And this is a listening session for the council and also for the Sykesville Planning Commission. And take it away.
What states did you want to start with?
I guess we could. Let's start with the Pledge of Allegiance. Thank you, Lisa. We'll all turn our backs to the cameras. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Stand for a quick moment of silence if you don't mind. Thanks, everybody.
How you wanted to handle questions and everything as we discussed, or do you?
No, go ahead. I mean, you guys. Okay, all right, great. Well, thanks everybody for showing up in public and for buying all this cool new equipment. I mean, this is great. It's going to be a nice thing to do. I'm Roger Conley. Am I on now? Okay, good. I'm Roger Conley. I'm the owner of the Warfield project, and been at it a long time now. It's almost 10 years. 10 years in the spring I first showed up. First came to Sykesville 20 years ago, fell in love with the place. I was looking for a place to put a business that wound up in Columbia. Couldn't find the right place, but loved the town. And it wasn't anything like what it is now. I mean, it's just so amazing, great transformation. Same thing 9.5 years ago. It was just some of these things were getting started, still dreams, trying to get them going, but it's been terrific. We've been through 3 major phases on the project so far, and I think hoping we're entering the 4th now. Took 2 years to get a sales contract done, purchase agreement, bunch of studies, trying to figure out which end was up, how it might work, how it hadn't worked, what we might be able to do, but we finally got to a contract. Took another 4 years to get through the zoning, preliminary plan, the final plan on the subdivision that the townhomes going up. Been 3 years into it now. Owned it for 3 years and total outlay probably $14 million. I mean, it's an awful lot of money to get it this far, to get these things to happen. But it is starting to happen. 3 years ago, totally different now that we have some things moving. So I'll talk tonight about some of the chunks of the chunks of the project. But there's a lot we're not going to get to tonight. I'm delighted to get back in front of you. We knew a year into it that we had some really significant issues that we needed to work together. And we got a lot of those on the table, but not really getting great progress. A lot of emphasis shifted over to things that we could do in Annapolis to try to leverage other resources to get things to happen that we just couldn't get to happen just on our own here. A lot happened there, and then COVID hit. And that 1.5 years has been COVID years, like dog years. You know, it's been forever, and things just... Anyway, so we're in a totally different place now. A lot of wonderful things, new opportunities, new things like that. But we're not going to get to all of that tonight. So there's going to be a kind of once-over on the status, some of the chunks, but the key things are trying to get data. We've learned so much over the last 5-6 years, and we've engaged several studies. So we're going to go in depth in a couple of things that have to do particularly with the impact of the project, how it's configured, some alternatives around that, and the market. What's the market telling us? What's the current state of the market in terms of things that might be successful there? On the impact side, it's It's kind of all over again, but it's also brand new. The town had originally selected a consultant, Tischler Weiss. Not the guys we wanted, but the town selected a really quality firm to do the first fiscal impact study. They were the appropriate people 2 or 3 years later when we were getting the final stages of the preliminary plan to go back in and reassess that, both to update it and to incorporate the new information. And the town had done a third study, again, just on fiscal impact, with Sage Group a little while ago. And so we engaged another one because we were hoping that that one would pick up economic impact, and it really didn't. So we did a third round, actually fourth for the study, but third round with Tischler Weiss that is going to talk about that specific aspect of impact, both economic and fiscal. What does it mean for the town? What does it mean for the county? What does it mean for the Board of Education? And if I may, delighted to engage all of your questions, but I don't know if we'll get them all after each speaker. But if you make notes of things you want to know about, things you want to follow up, things you want more information, more data on, we'll either do it in subsequent meetings or we'll get it to you by email or whatever it is. I want to make sure that we're getting the information to you. There's so much that's happened, and we've not had this dialogue for so long that I'm hoping that we can do more meetings. Weekly, bi-weekly, monthly, whatever it is, whether it's the whole team, part of the team, workforce, committee, whatever it is, we're completely open to that. Really, it's time for us to engage some of these issues constructively and together to get this done. So with me tonight are the rest of the players. Steve McLeaf, who's been working with me more than 5 years now. Very broad background in construction, banking, development, all these different things, and commercial, and all different kinds of real estate for the last 30 years. So really been helpful to me in getting things done from the preliminary plan on through. The other guy who will be speaking tonight, Ethan Reed. Ethan's right here. He's with a real property research group. Before that, he was with CoStar. CoStar is the giant commercial database for what's happening in the region, things like that. So he's an analyst with CoStar, been with RPRG for 7 years now. Bachelor's and master's, both in appropriate things in business administration. And then Ben Griffin, over here. Ben's also got bachelor's and master's degree, finance and urban and regional planning. He's been with Tischler Weiss for 5 years now and has been the primary author of this latest piece of research. So hopefully it'll give us a lot more information in terms of what's going on out there. A lot of things that we thought might be true, but this will be a great deal of data. And there's a ton of data in there, but we've asked them to try to do bottom line for you and then give you the backup. So all that will be in the packages that you get. So you'll hear some things, you'll hear his take on it, and then you can come to your own conclusions or ask some questions, that kind of thing, as we get into it. More than 20 years ago, when the town had identified this, Mayor Herman was working to get that together, he'd actually gotten the state to agree to give you 141 acres, I think was the original number, in a huge piece of property. And it included all of this that became the state police headquarters. So both sides of Piney Run were included originally. Really, really significant piece of property. But the state, as part of its surplus and process, also puts it out to state agencies and says, anybody else want this? Going. And the state police came there. They had originally kind of targeted the Martin Gross facility, the men's campus up the road, but decided that this was more appropriate, so they came in and kind of took that back. Separately, the town had acquired the substation as part of that land transfer, and then the state said, wait, we didn't mean that. So that got removed. Piney Run was a giant win for the town. It's roughly 28 acres. Includes all of this that the town got as part of that package deal, and that was not a part of our acquisition, so it's still a town park, some wonderful improvements. and some additional improvements that we're going to be doing later on to address that. The other 4 parts of it that I acquired, not including the little parts in the middle, but most significantly was the historic campus, the beautiful buildings. That's why I'm here. I mean, it just really struck just the character of the buildings. They're wonderful old buildings. I'm a history nut anyway, and so it just really spoke to me. And so we've been working hard to try to save these. It's very difficult to do that, but we're trying to get that done. We have some vacant property here, which we call parcels C and H, that are the open space that's next to the Nexion building, up here, and then H is actually the one that has the water tower on it back up in Buttercup Road. We have 2 parcels up front that were originally, and all these are just examples. These are 5-year-old sketches in terms of what could go there. But these are new construction here, a couple of new construction, maybe it's retail, maybe it's something else, but 2 parcels up front. And then the parcels that became the townhome. So these are the only ones that are coming up right now. But they're doing great. When they launched, they were selling at $425 was I think the introductory price, 145 units. They've sold 80 some units now. They're not all even up yet. But the first level of the roads are in now, all completed. They're building them as quick as they can. They're selling very well. They're selling for about $100,000 more than that. The typical price is in excess of $500,000 then. So really doing well, building out quickly, big demand for their product. So that's where that one stands. On the historic campus, there are 3 buildings that have been occupied. So Jonathan Herman did the G building on the top of the hill. The dance studio is now occupied by Alderson Loop. Very interesting, innovative technology resource company, woman-owned business who's growing like crazy and doing very well. And then Nexion, the original pioneer out there, Fran Curley, with his building. And then I have invested a lot of money in the 2 buildings next to that. The F building immediately adjacent to Nexion, and a lot of cleanup of the W building, the one that's sort of house-like. That's why Warfield has the name Warfield. Was Governor Warfield came in to dedicate that, 1905 or whatever it was, sort of Teddy Roosevelt times, and that's when they put the Warfield name on that campus. Some of you might remember when we did the ribbon cutting for the townhomes that Edwin Warfield IV, his great-grandson was there. His great-great-grandson, the 5th, couldn't make it that day, but they've both been up to take a look, but it's the old Maryland family. Anyway, that's kind of a quick once-over on where we are. What happens to all of these and what happens with these is really going to be the subject of an awful lot of conversation that we have coming up. We've been marketing this for a long time. CoStar, we had started with, we've been through a couple of different brokers trying to get traction on commercial tenants for that building. We've got a complete set of designs as a multi-tenant office building, but just haven't found users. Nobody's lined up quite right. Lots of small ones, lots of looky-loos, and a couple of them that want to do multiple buildings, but once they got into the cost of rehabbing those, we didn't really get there. But that's the status, is trying to figure out then what happens to the other 11 buildings. There's a terrific resource in the middle of it, the dining hall and amphitheater. That'll be a separate conversation when we get further along. But only those 3 buildings plus this one are the ones that are really in flight right now, and just a little bit of work on the W building. So if I can go ahead and turn, unless there are questions at this level, I'd like to go ahead and jump into the analytics in terms of what's happening in the market, what the impacts are of these different scenarios and so on. And if you'll go ahead and do your piece, I'll grab my mask, excuse me. And then I'll introduce a little bit what the scenarios are that drive the economic and fiscal impact. But first we'll do the market data.
It's nice. See that? And Joe, the public can see this?
Yes.
Thank you.
Once I stop that.
I don't want to see the ceiling.
Thank you, Roger. Good evening, everyone. In November of 2020, RPRG completed a market feasibility study and opportunity assessment for the Warfield redevelopment site. The scope of the study included defining a primary market area, evaluating economic and demographic trends, and analyzing the potential for multifamily rental, residential for sale, senior rental, and commercial uses at the subject site, with conclusions and recommendations. Today, we'll provide a brief summary of some of the key areas of the study, focusing on broad market conditions and implications for development opportunities at the Warfield site, though the findings and conclusions are based on the broad market and not necessarily site-specific. Our study was comprehensive across a variety of sectors, and for the sake of time and the sake of not putting you all to sleep, we're just going to address the broad key summary points and provide supplemental data tables you can reference later. The data and findings are all from our November 2020 study, but conditions and projections are believed to have generally remained consistent, with trends presented in our study only intensifying in recent months.
Can I just clarify, you said it wasn't site-specific, these are just for the general Eldersburg-Sykesville area?
The study provides market conditions and trends that indicate whether new supply could be delivered, whether it be the Warfield site specifically or a site similar to it. So it's more based on the market conditions and trends rather than what's feasible for this site.
Each segment will show you which comparables were used for which portion of the analysis, so that you'll see specifically what comparables.
Let me make a clarification. So even for instance, if what you don't take into account is if we have extraordinary soil conditions or something on a site that you say, oh, there's a big crop of rock here that's going to make which we don't have rock on the site, but we have some sort of subsurface condition that would render it infeasible. You're focused on the market, you're not focused on engineering.
Exactly.
So when we're talking site specific, we're not talking about the dirt and getting utilities to the site and things like that. It's just market feasibility.
Okay.
Thanks for the question, Susan.
Yeah, you're a slide behind, so
There we go.
there we go.
Carroll County has a relatively diverse employment base and slowly expanding economy with unemployment rates below state and national averages. Carroll County's unemployment rate has improved significantly in tandem with state and national trends following the previous national recession of 2008 through 2010. The 2019 annual average unemployment rate of 2.9% was well below the 3.6% statewide rate and the 3.7% national rate. Reflecting the impact of COVID-19 related business closures and layoffs, the unemployment rate spiked to 9.0% in the county, 9.8% in the state, and 14.7% in the nation in April of 2020. The unemployment rates in all three areas have decreased significantly in subsequent months from May through September 2020. With businesses reopening, the county improved significantly to 4.7% as of September 2020, below statewide rates of 6.9% and national rate of 7.9%. Carroll County experienced moderate job growth in 8 of the past 9 years, from 2011 through 2019, with net growth of 4,613 jobs, or 9%. The county added an average annual of 513 jobs over the past 8 years. Now, job growth was slightly higher in 2016 and 2017 before turning negative in 2018, as you can see in the chart, followed by continued moderate growth in 2019. The rate of job growth has generally been below that of the nation over the past 8 years. The average annual wage in Carroll County as of 2019 was $44,813 compared to $62,976 in Maryland and $59,219 in the nation. To analyze demographic trends in competitive real estate markets, we focused on a primary market area comprised of census tracts encompassing the south central Carroll County neighborhoods surrounding the subject site depicted in the black boundary.
Is there any way to expand your PDF file like on the screen so that it's filling at least the full margin of the?
Should be able to enlarge
zoom in?
it.
Yeah, like that, right there. Click on that.
All
I mean, it's a PDF, it's not a PowerPoint, correct?
Right.
I was gonna say, can you do full screen?
We'd have 11 to get a little bit more, but that's...
What'd you say? Oh,
Last time
I was gonna say, you're moving faster than it is.
Yeah, give it a second to, there we go.
It's going to respond a little slow because
To redraw.
running Zoom in the background, so be patient.
how about that?
Now we're cooking.
Will that work? Oops. You want to go with this?
That's good, I think.
All right. Now, how do I?
You gotta go to the next slide and be all goofed up.
So it goes down to 70. So the map is down to 70 to like a little bit of Howard County, it looks like.
If you're not gonna be
Right.
able to switch slides, my friend, it's fine. I thought it would be a quick fix.
Can you,
Zoom back out.
can you switch to the next one? I don't know.
Well, no, here. Get you zoom in.
Page down?
Way to go there.
So it had slivers
There
of
you go.
Much better.
Let's do page down.
Yeah.
All right. According to estimates and projections provided by Esri, a national demographic data provider, and the Baltimore Metropolitan Council, the Warfield market area is experiencing moderate population and household growth, which is projected to continue through the near future. The Warfield market area experienced a period of stronger growth from 2000 to 2010 as the household base increased by 5,364 households, or 16.2% between census counts, followed by an increase of 2,167 households, or 217 households per year, or 0.5% annual growth from 2010 through 2020. The BMC projections indicate the market area's population will grow annually by 570 persons, again 0.5% annual growth between 2020 and 2025, while the number of households will also increase annually by 0.5%, adding 207 net households per year. Growth among senior households has been more rapid than the general population, as senior growth is generated by not just in-migration, but also aging in place into the older cohort. With annual growth of 2.6% among households aged 55 and older, and 3.1% among households aged 62 and older from 2010 through 2020. Senior households aged 55 and older are expected to increase at an annual average rate of 1.4%, or 302 households, while senior households aged 62 and older are projected to grow at an annual rate of 374 households, 2.4% over the next 5 years. Though primarily a homeowner market, renters have comprised an increasing share of net household growth in the market area over the past 2 decades. From 2000 to 2020, the number of renter households increased by 1,077, or 17.3%, while the number of owner households increased by only 3.4%. During the past 10 years, renters have comprised approximately half of all net household growth in the Warfield market area. In Carroll County, renters have comprised almost all net household growth, a further indication of recent shifts towards renting over the past 10 years. According to Esri data, renter growth will continue at a high pace through 2025, potentially restrained only by lack of rental supply.
I'm sorry this is so hard to read. He's clicking past the data, but each of these is the data sets from which those conclusions are being drawn. They'll be in your package. So each time you can take a look at how he read it, how you see it, but it's all in there.
Households in the Workfield market area have a 2020 median household income of $114,778 per year, 16.5% higher than the median income in Carroll County of $98,550. Esri estimates that the median income of the Warfield market area households by tenure is $61,473 per year for renters, $126,687 for owners. The 2020 median income for senior renter households age 55 and older in the market area is $53,361, and the median 55 plus senior renter household income is 51.3% of the median senior homer household of $103,948. Looking at households age 62 and older, incomes are a little bit lower with a median income of $48,762 among renters and $88,575 among owners. For our retail analysis, we look to current and historic market data compiled by a third-party commercial real estate data provider, CoStar. According to CoStar, the Carroll County retail market has a third quarter 2020 vacancy rate of 4.2%, though absorption during the past 12 months was negative 120,110 square feet, absorption being the change of occupied square feet from period to period. So there's 120,000 square feet less occupied square feet over the past 12 months as of third quarter 2020. Also bear in mind, commercial real estate markets are not as efficient. Trends take years to manifest due to lags of pipeline and lease terms. So as leases expire and businesses who've been struggling to survive over the past 12 months may choose not to release, vacancies would increase. As of third quarter 2020, asking rents averaged $18.88 triple net per square foot per year. But we note that these are asking or quoted rents, typically higher than what is eventually negotiated and effective and signed for the lease, and they don't include additional concessions made by the landlords. Recent trends indicate stagnant rent growth in the face of rising construction costs, which is common across most markets in the country. The local retail market has fluctuated over the past decade, averaging a minimal 11,338 square feet of absorption from 2009 to 2019. However, in 2018 through 2019, absorption trends began a sharply decline to roughly 30,000 square feet in 2018 and 20,000 square feet in 2019. CoStar data and projections indicate that the retail market is now turning negative again, with 87,919 square feet of negative absorption projected for 2020, followed by continued negative absorption projected in 2 of the next 3 years. For our more specific trade area, defined as a 10-mile drive time from the subject site, a survey of 12 market area retail listings indicated a total of 70,869 square feet that was available. Retail rents range from $10 to $35 triple net per square foot per year, with lower rents among older freestanding or strip center space and the higher rents among newer shopping center development in Eldersburg at the 3226 intersection or the Eldersburg Commons by the Walmart. Several of the surveyed retail spaces are among flexible strip centers or business parks that also accommodate office or flex space. The most comparable location identified at the time of our survey was a retail component of Johnsonville Station within 1 mile of the subject site along 32, a modest strip center built in 1999 asking $20 triple net with expenses of $7.85. Discussions with local commercial brokers have confirmed the trends that we saw in the CoStar data. Retail space in our area is increasingly challenging to fill with rent growth stagnating. Listing brokers don't typically go on record as saying that it's a tenant's market, that it's challenging to list space as that's counterproductive for their negotiating, but all 3 brokers we interviewed confirmed that they've an increasingly challenging environment to lease all types of retail space. The office flex inventory is modest, primarily comprised of flexible low-rise spaces that can accommodate traditional office use, as well as medical, retail, or service providers. CoStar reports the Carroll County office market has a vacancy rate of 10.5% as of the third quarter of 2020, higher than the 9.9% throughout the Baltimore region. Net absorption has been minimal, with 11,239 square feet over the past 12 months at the time of our survey, with average asking rents of $18.24 full service gross. Similar to the challenges in the retail market, the office market has increasingly struggled since 2016, with CoStar reporting negative absorption in 2 of the previous 3 years, negligible absorption projected through end of 2020, and CoStar projects declining demand continuing, resulting in negative absorption and higher vacancies over the next 4 years. Flex space, defined separately by CoStar as a hybrid of industrial, office, or retail space with lower end finishes, is underperforming in Carroll County with an average vacancy rate of 18.6% and an average asking rent of $10.08 triple net. Similar to the trends we've seen in the retail market, the office market across the country has increasingly been threatened by shifts towards working from home or co-working. The ratio of office square feet per employee among office-occupying businesses has continued to shrink, and COVID-19 pandemic has significantly sped up this long-term trend we are already experiencing. Some projections indicate that up to 50% of companies which shifted employees to working from home during the pandemic may not return to their office space or will significantly reduce their office footprint. Our PRG surveyed 9 office flex listings in the trade area with an average year built of 1984 and asking rents ranging from $12 to $20 full service gross. One of the newest business parks in Carroll County, Liberty Exchange, is along Liberty Road west of 32 and includes 6 buildings totaling 170,000 square feet of office, medical, flex, and retail space. Initial buildings at Liberty Exchange were built in 2012, but the most recently completed in 2019 at the time of our survey. And the park was roughly half occupied at the time of our survey with asking rents of $12 to $20 depending on finish. Looking at the for sale residential market, resales of homes and lots throughout the MLS system in Carroll County suggest increasing demand and pricing, which has become all too apparent in recent year as anyone who's tried to buy or sell a home has found out. Monthly sales has been steady since 2015, typically peaking at 275 to 300 units sold per month during summer months. And the median sale price of these homes peaked at $390,000 in the summer of 2020, which was the highest median sale price ever recorded. The MLS recorded 1,772 residential sales from October 2019 to October 2020, and 83% of the sales were among single-family detached homes. The median sale price across all unit types of this period was $400,000. And the overall average asking price was $431,420. Townhomes averaged $306,580. Single-family detached homes averaged $461,342, and the average price of a condominium was $231,004. As you can see in these charts reflecting MLS trends, in recent years, prices have been rising, sales pace has been increasing, while available supply and inventory decreases sharply, resulting in a lack of available housing, especially for the middle class and workforce households, which yields unmet demand for both for sale and for rental housing, as households desiring to live in Carroll County seek housing alternatives. Despite the relatively lower nature of the development in this area, we have a fair number of townhomes and condo sales during the 12-month period of our study period, showing a wide range of prices with high-priced townhome sales near the Warfield subject site, especially at the neighboring Parkside development and the Raincliff townhomes to the south. We identified and surveyed active new home communities of more than 10 units, focusing on new townhome communities. As the market area only includes one active townhome community, the adjacent Parkside development, our PRG also surveyed 2 townhome communities near the market area, as well as 3 master planned single-family developments and near the market area for competitive context. Besides the Workfield and Warfield townhome community, the remaining 2 townhome communities are northwest of the market area in New Windsor and Tawnytown, 18 to 30 miles from the subject, single-family developments in Westminster, 15 miles from the subject, and in Mount Airy, 14 to 17 miles from the subject. In all, our PRG surveyed 6 communities in and near the Warfield market area. 3 townhome communities have 3-story attached units with 20 to 22-foot widths and attached integral garages. Single-family communities all had detached homes on 0.2 acre or 0.3 acre lots. Average sale paces for all surveyed communities were very strong. The average sale pace across the 3 single-family subdivisions was approximately 4.2 units per month. The average sale pace for the 3 townhome communities that were surveyed was approximately 6.0 units per month. The average base prices for the 3 single-family communities range from an average of $532,130 to $636,000, with an overall average base price of $573,623, or $206 a foot. The 3 townhome communities that were surveyed had an average base price ranging from $242,740 to $442,990 at Parkfield at Warfield, adjacent to the subject, with an overall average base price of $327,907 or $183. And as Roger mentioned, Parkside of Workfield has continued with a very strong sales pace and significantly increased sales prices since the time of our study. For our senior rental analysis, a variety of shelter options are available within Warfield market area and the wider Carroll County area, restricted to seniors and specifically designed to meet their unique housing needs. The shelter options are typically based on activity level of targeted residents and the types of services required as a result of the varied capacities. Independent living communities operate as conventional apartments without any services included in the rent. Congregate senior communities are independent living but include a standard slate of services such as meals, housekeeping, laundry, linen services, planned social activities, or transportation. Assisted living communities represent the next step on the continuum of care, from congregate communities for frail individuals requiring services of all meals, housekeeping, assistance with grooming, dressing, bathing, medication assistance. Skilled nursing and memory care facilities are designed for the frailest tenants with the lowest activity levels. Skilled nursing facilities are in fact medical facilities. And continuing care retirement communities typically charge a substantial buy-in fee, often hundreds of thousands of dollars, and offer several or all of the housing options discussed above in a single campus site. We first conducted an analysis of senior independent living options in the Workfield market area. The only congregate senior community with included services in the market area is the independent living component of the Fairhaven, 1 mile west of the subject site, which is a continuing care retirement community that includes both market rate independent living and assisted components with a higher entry fee. 2 market rate congregate senior communities outside the market area were also surveyed to the north in Westminster and further west of the market area in Frederick. Snowden Creek is an upscale market rate senior community without included services 3 miles north of the subject site in Eldersburg. The remaining market area independent living communities are income restricted tax credit communities. We also surveyed 1 additional market rate independent living community just south of the market area in Ellicott City. The 3 congregate senior properties had an average year built of 1994 and the independent living communities had an average year built of 2009. All 3 congregate senior communities reported full occupancy with wait lists. The stabilized independent living community reported a vacancy of 1.4%. The new independent living community, Snowden Creek, opened in January of 2020 and leased 70 units as of our October 2020 survey for an average absorption rate of 7.8 units per month. The average effective rents among the congregate senior communities included studio rents for $2,721, 1-bedroom rents for $3,531, and 2-bedroom rents for $4,452. But bear in mind, these rents are higher than typical as they include a premium for being located within a continuing care community. The rents among market rate independent living communities are 1-bedroom rents averaging $1,522, 2-bedroom rents averaging $1,876, and 3-bedroom rents averaging $2,375. Our PRG also identified 351 assisted living units in 6 communities throughout the market area and surveyed 2 upscale assisted living communities near the market area, totaling 134 units. The nearest community, Fairhaven, is a continuing care campus, again, directly west of the subject site, offering additional senior living services, including independent living and long-term care beds. Brightview Westminster has an independent living component as an assisted living component. Among market area assisted living units, the overall vacancy rate was again very low at 1.4%. Among market area assisted living communities, efficiency rents averaged $3,183, 1-bedroom rents averaged $3,996, and 2-bedroom rents averaged $4,256. Among near market assisted living communities, efficiency rents averaged $2,327, 1-bedroom rents averaged $3,491, and 2-bedroom rents averaged $4,079. Entrance fees vary among the survey communities, ranging from no entrance fee to over $300,000 at Fairhaven, depending on the level of service chosen and living accommodations.
Crazy.
For our multifamily rental analysis, our PRG surveyed 18 general occupancy multifamily rental communities in the Warfield market area. Rental communities were segmented into upper tier and lower tier based on age and quality of construction, features, amenities, and pricing, though the market area is definitely lacking new high-quality rental communities, with only one community delivered to the market in the last 28 years. We also surveyed 2 communities just outside the market area to offer a better representation of newer quality multifamily product. The surveyed rental stock reflects the suburban nature of the area, with almost all surveyed communities including either garden or townhome units. The market area multifamily inventory was performing very well at the time of our survey, with an overall aggregate vacancy rate of only 0.7%, indicating a substantial unmet demand for rental units. The upper tier vacancy rate was 1.2%, while the lower tier communities all reported full occupancy. The one stabilized near market community also reported full occupancy. Average effective rents among upper tier communities were $1,164 for 1-bedroom units, $1,426 for 2-bedroom units, and $1,635 for 3-bedroom units. Average effective rents among the near market communities were $1,593 for 1-bedroom units, $1,935 for 2-bedroom units, and $2,063 for 3-bedroom units. Most of the survey communities were in the far northern border of the market area near Westminster, with few multifamily rental options south of Westminster. Our PRG identified 3 multifamily communities totaling 140 rental units that were under construction or in initial planning stages in the Warfield market area, which we would include in what we call the near-term pipeline, expected to be delivered in the next 3 years.
What would be the typical vacancy rate of a served community? Like there's enough inventory for rental, there's enough people there. What would be the vacancy rate of a served community?
The industry typically considers a 5% vacancy rate to be a stabilized or healthy market vacancy.
Okay, thank you.
So 0.7% is
Very
extremely
low, yeah, no, I know, you said it was low, but I was just wondering what the average was.
So moving on to the conclusions of the data analysis. CoStar projections for negative absorption, rising vacancy, and stagnant rent growth for commercial markets, including both office and retail, is confirmed by observations made specifically in the subject South Central Carroll County trade area and confirmed by the surveys of our local commercial brokers. We're seeing long-term shifts in market fundamentals, and CoStar's projections of negative absorption, which again is a decrease in occupied square footage, may actually be understated as there is lag times in trending. A cautious and conservative approach was recommended for any commercial development in this area predicated on pre-leasing. The traditional bricks and mortar retail industry has suffered during the past decade, while office users have been trending more towards home or working from home or co-working. The current COVID-19 pandemic just exacerbated these long-term trends, putting further pressure on traditional retailers and office operators. CoStar's projections of negative absorption and rising vacancies reflect these challenges. Therefore, it was recommended in our study that any commercial development should be at a later stage only if market conditions improve or if a build-to-suit opportunity happened to present itself, but that would be on a unique case-by-case basis.
So I have one question in reference to that. So the negative absorption rates that you're reporting does take into account the impact of COVID, or it doesn't take it in fully?
That was as of the third quarter of 2020. So at that time, we were well underway, so we could see the trends. However, like I said, we were already seeing those trends taking place before the pandemic. The pandemic then just exacerbated it.
Thank you. And I'm Jeremiah Schofield, council.
I forgot we were supposed to do that.
Just real quick, Ethan, looking at the CoStar numbers too from this May report, the 12-month negative net absorption was 81K, right? And how does that compare to what you had said?
For 2020?
Yeah,
For which one?
for retail.
So that's pretty similar, actually.
Yeah, so the trend continued.
Yeah.
Has continued into the year.
Yeah.
I realize one of the things that Ethan was concerned about coming in was that like we're six or so months
No,
behind, right? So-
read all three numbers from the top. This is, or all four numbers. This is the most recent 12-month data from CoStar.
Well, so the relevant numbers are, there's negative 81,000 in absorption. Vacancy rate was at 4.6%. 12-month rent growth was negative 0.2%.
So rents are dropping, and negative absorption, 88,000 coming on the market.
That's the clarification I wanted. Are asking rents dropping or actual rents dropping?
So the data that we have is for asking rents. But if
Yeah.
if asking rents drop, then effective rents would have to drop.
Not necessarily, but, so the analysis here is on asking rents
Correct.
and not on actual rent.
Correct.
Okay, thank you.
Steve
Actual
Enslow,
rents-
Chair of the Planning Commission.
So
Thank you for the introduction, sir.
So when we say asking rents, so you have asking rents, but then you have in-place rents,
Yes.
which are a different survey, but then what really matters is what are contract rents? What are tenants contracting at? And when you have negative absorption, you're not getting new contract rents.
And several of you would know all about this, but asking rents don't reflect free rent at the outset, TIs, that is tenant improvements. There are a whole lot of other deals that mix into what the effective rate is. And those of you who are knowledgeable about it can explain if others of you have questions. But it's the best proxy that you can get in a broad market area is that asking rent.
So Elizabeth Garoff, council member, a couple questions. The unemployment rates, do you have that by people who are in county and out of county? In other words, my understanding of Carroll County is we have a very low unemployment rate, but most of us leave the county.
So the unemployment data is for residents, working residents in Carroll County.
Residents working and living in the county?
Residents living in the county.
Right, but I'm asking, do you have that by what percentage of the employed work in county versus the percentage of people employed who are commuting out of county?
I don't have it broken down between those two.
That's my question. Because my understanding in Carroll County is we have a much higher commuting out rate.
That is correct. Yeah.
There are data available from the earlier studies. Dan, is that in this version? I don't think it is.
It's not in this
But we have data, earlier data that talks about in and out migration, working population, so we can get you some of those numbers
Yeah, that
from
is
the
in our
earlier
study.
studies. Yeah.
Yeah.
Okay.
Yeah, so in our study, we did look at the in-migration, out-migration of workers who live in Carroll County and work outside versus those who live outside and work inside. And there was a net out-migration of workers.
Right.
We also try to get for Ben updates from the County Economic Development Department from their data services, and there wasn't much detail there yet for that kind of question.
Mm-hmm.
There's sort of some generic things which I can get to you, but it was better employment data than commuting data.
And then my other question is, the area that you have includes Carroll, Baltimore, and Howard counties, mostly residential. So to bring it really close to home, did you compare anything to Main Street and Sykesville?
For
rent, for occupancy,
For residential?
for
retail?
commercial?
For commercial. So for our commercial survey, so CoStar's includes all retail.
Right, I'm asking, did you bring it really close to
For our
home in
survey,
terms of comparing?
we surveyed
against-
all available retail spaces at the time of our survey. We tended to capture all those within that trade area.
Right, but my question is, did you single out, do you have data that singles out our Main Street? Because my understanding from our Main Street is it's not those trends. So that trend might be a bigger area, but Main Street here, if I understand it.
You're understanding that correctly.
Okay. So my question is, since we're looking at that as a commercial space in tandem to what we have on Main Street, do you have data of how our Main Street is doing compared to the larger area that you used?
That data wasn't available at the time of our survey, or really included in the scope of our study, but we did include those spaces in, I believe we included at least one or two of those spaces in our survey.
Okay.
Just anecdotally, when I've spoken to folks on Main Street, you guys are at full occupancy and have a waiting list.
Correct, that's why I'm asking.
It's a much different type of market. It's a very special market compared to fighting it out in a more generic market, like, let's say, Eldersburg, which is huge.
Well, and that's why I'm asking,
Yeah.
because I'm worried that the data is too big to get any sense, because if this is connected to our main street, then this data doesn't, the data's too broad in a
Well,
rural.
the purpose of the market study was, though, I understand your question. The purpose of the market study was to help us determine what's viable up at Warfield.
Right, but
Okay.
Warfield's an extension of Main Street.
I understand, but if we use Main Street rents, I do know anecdotally, talking to folks, that they're paying much lower rent than they're paying than people are asking for in Eldersburg. That doesn't help us at Workfield, right? We need a higher rent to cover a higher cost basis. So the reason that, I hear what you're saying, but what he was trying to do is figure out, okay, what's the market so you can go and try to underwrite a deal.
And I'm not,
Yeah.
I understand that. My question is,
We're good. She's asked the question, you've answered it, we can move on. Let's go. Thanks, Lisa, it's thoughtful.
Totally lost his train of thought.
Okay, let's go here. So based on our preceding analysis of the demographic and competitive dynamics within the Warfield market area, there was concluded to be a very strong opportunity to construct an attached for sale phase of the subject site. For sale residential trends were extremely strong at the time of our November 2020 study, and since then demand has only become stronger, with demand among entry-level buyers as well as higher income move-up buyers. The success of the adjacent park site at Warfield Townhome development by Lennar Homes demonstrates the desirability of the subject location and sufficient market demand for this product type. A for sale residential component of a similar type and size at park site at Warfield could be considered among initial development phases for the subject site. The senior rental component would most likely be a service-enriched independent living concept, which is not really available in the market. Our initial analysis indicated market demand for conventional senior independent living. The market's only service-enriched congregate community is, again, part of Fairhaven's continuing care retirement community, which requires a substantial buy-in fee. A service-enriched congregate community at the subject may have some overlap with the target market of Snowden Creek, but would not be in direct competition. The market shows sufficient demand and lack of supply for a senior rental community like this, but it would be recommended for a later stage of development, as there's always a caveat for projecting senior rental demand, as it's more of a discretionary decision rather than a needs-based decision. Market conditions at the time of our survey indicated a very strong rental market, with property managers indicating strong demand and insufficient supply to meet the needs of the market area renters. Our net demand analysis for multifamily rental units reflects the strength we're seeing in the residential rental market. The net demand analysis calculates the number of units that are in demand in the market over the next 3 years compared to the amount of new supply expected to be delivered over that 3-year period. And the results of our analysis indicated that there was excess demand for at least 300 rental units in an initial near-term phase at the subject site, with potential for additional units in later phases. And these calculations utilize conservative assumptions. We then performed an income-qualified demand analysis, testing the number of upper-income and moderate-income renters projected in the market area, which yielded sufficient demand for both upscale market rate units priced above the current market, as well as more affordable workforce rental units. Both segments are currently underserved by the existing multifamily rental stock.
Just another question in reference to that. Is that data available, the back-end data for that last study that you just explained? I didn't.
Is that in the detail that you have in there, Ethan?
We didn't include that in the
Okay.
table.
We can get you that table.
And maybe it's in there and I just missed it.
No, we can get you that table.
Thank you. Again, that's Jeremiah Schofield. I'm here all night.
I hope not.
That was Anna Carter.
On that note, in conclusion, our findings indicated the strongest opportunity for the subject site was for residential uses, primarily among market rate and workforce multifamily rental, as well as for sale residential such as townhomes, followed by a possible senior rental community. Opportunities for retail in the near term would be limited to small format retailers or service providers serving more as an amenity for the residential components. These would likely be no more than several thousand square feet in the form of a cafe, daycare, or dry cleaner, serving more as an amenity for residential components and likely not as a profit center for the development. Larger retail or office development, or even moderate-sized retail office development, was recommended to be delayed until or unless market conditions improve or a feasible built-to-suit opportunity became available, though again, that'd be on a unique case-by-case basis.
And I believe that Phil Singleton from the Planning Commission has a question.
I do have a question, yeah. I looked back just before it came out to the 2016 map of the planned employment campuses, the whole thing was called. And it seems to me that tonight we're being presented with perfectly valid market research and conditions between two choices. One is a choice between commercial office space, and the other is a choice between residential development. And yet I remember sitting at that very table as a planning commissioner over many hours and working out the many, many permitted uses for each of those parcels, A through H to I. What research has gone into the other permitted uses, which might be that, for example, parcel B was planned for a hotel on that map. And there are many, many other permitted uses which don't involve commercial offices where people transfer files and cubicles. What research has been done on that?
You know, we did research on retail, and those front parcels were in the existing plan slated as retail or similar types of uses, not as office. We marketed this, to answer your specific question about hotel. Hotel was not within the scope of this study because we had been out to market on hotel and spoke with several hotel groups and even looked at doing it ourselves because the numbers that we were getting for the sale of the land wasn't enough to cover the cost of site development on those parcels. So my recollection was that we were getting offers of, say, $7,000 to $9,000 a key, a room. And as you recall, we contemplated up to 125 keys on that parcel B in that PEC, that sample PEC plan. What the market told us, and we dealt directly with, in particular, Choice hotels and who studied it and provided some information to us on it. And really, what they were suggesting there was no more than, if we really pressed them, 90 keys. And most folks would come in who were making offers at 70 to 80 keys. So to answer your question, is the real market study there was being out in the market very, very early on and getting offers that just were not only fewer keys, but a lower price per key. And I think the other thing that was a deterrent, aside from it's not a very deep market. It's not a very populous market. There's another hotel planned up in Millersburg that Black Oak had going through the process. So, that was seen as a more desirable location.
At the time we were going through that, I had very senior connections in two of the national companies that are headquartered in Bethesda. So we ran around and that got some general indicators and so on. So what was in the plan was 125 rooms. We spent a ton of time and effort on this Choice deal. 2 different room levels in there, extended stay and traditional shared facilities, said no more than 90 rooms. We went over and over and over and over that. And despite every incentive they could think of, year-end, a little more than a year ago, we couldn't get a deal that I could begin to afford. It was less than half the return that we expected. So you'll see the hotel in the scenarios. I'll describe that in a minute, but there's no way the hotel's going there. I thought it'd be terrific because you got to drive so far to find a place here. I thought there'd be a much bigger market, but we haven't found it. So if any of you know of somebody who wants to build a hotel or to talk to local hoteliers here, and not been able to get in.
That deals with parcel B, which is what the hotel was slated for. We still got parcel A through H and I. there are many other permitted uses which don't involve
And
commercial space.
you'll see secondary uses, no, I mean, we've tried all kinds of things, we've also been in the market for 5 years. I've had the F&W building, every other element, sorry, most of the other components have been only out there for 3 years, and this year, I've been paying through the nose to be the #1 listing on any kind of commercial activity in this market area. We purchased the top slot in CoStar. I'm looking for businesses to come to me and say, hey, I've got a business, I want to be here. I'm not going to build a restaurant, I'm not going to build a hotel. I have space available for people who are interested in doing it. And we've taken the earlier leads that we had from companies that have been tossed around at great deals we were coming into it. We've worked those guys to death, and there's nothing there. Even when we've gone down to the developers, who've gone back to those companies. So I haven't found it yet.
Bill, to answer your question though, I think Ethan, you covered in your recommendations, I think is part of the, so let's talk, retail is different than commercial flex, okay? So let's talk about the retail. We talk about specialty uses, included in that are daycare or preschool type uses, correct?
That all falls into the retail.
That all falls into that. We've talked gas and convenience, we've talked, you know, there has been some interest expressed by discount retailers in the 8,000 to 10,000 square foot range. They would be names that are familiar to you that I can't say here, but that discussions are ongoing with. But, I mean, so there are things, that it comes down to price and what will become economically viable out there. So no, we didn't explore with the market study at a micro level every potential use. There is a list of uses in there. And the term retail is kind of all encompassing to include restaurants, daycare,
Neighborhood service providers, you know. I guess that may include, a hybrid might be an urgent care, even though that's kind of a medical. Yeah, more the healthcare.
Yeah. But we didn't drill down that far in there.
Okay, well, thanks.
Can I ask what is the profit margin you're willing to accept or you're looking for? Because it sounds like you've had discussions, but you're saying it's not getting you the profit that you want on them. So what profit?
Not just profit, we can't cover our costs of delivering it.
Yeah.
It's not, we're not to profit yet at all. I mean, we're not on any kind of return. I'm just trying to, can I afford to deliver this parcel in this form for this use? And generally, we're not there yet.
I think it's helpful to talk about what's happened. So would we all agree that construction costs, development costs for nearly everything over the past 10 or 20 years have increased? I think we can all agree upon that. If you look, when you look at the granular data that was very hard to see on a small screen, you'll see that supply has been relatively flat. Rent growth has been relative, I mean, it's up like this, but rent growth is relatively flat. Sales prices for office and for retail are below the cost to deliver it today. So in other words, you know, the market, rents haven't risen enough to support the increase in costs every year. And things are selling, okay, existing properties are selling for less than we can build them. So it's not a matter, I think, where Roger was going, of accepting of being, you know, piggy about it and wanting an above market return. It's about the market being there at all for certain things. And now remember, and you can tell me a little bit more about the inventory specifically up in Eldersburg, which is the closest, but I think is there 1.6 million in retail up there probably?
About 1.5 million.
And you have every major grocer and every major drugstore chain and Walmart, which is a magnet for all of these. And that's very difficult to compete with in a market where your population growth is relatively flat and, you know, over the course of 2 decades. And you don't have a lot of rent growth. It's a pretty crowded market. So it's not a matter of, gosh, it's not enough money. It's not enough money to cover the cost, is what it comes down to for certain types. Compare that to what's happened at Parkside, okay? And what's happening with housing everywhere right now. You know, they were in the low, as Roger said, in the low fours. I spoke with the folks over there this afternoon, and they haven't had a sale in the fours. It was 490 something in June. The last several sales have been in the mid fives.
Yeah, I was just
Yeah.
asking about what profit margin you were looking
Yeah.
for.
There's a different way to look at it for any commercial listing, and you'll see a bunch of them in there. It's cap rate, it's called, capitalization rate. And it's the inverse of the return on the cost of acquiring that building. So for example, if a cap rate is 10, means 10%. So the inverse of that, so you buy it for $300,000, it's a $30,000 a year return. So you'll see some other numbers in there, 14, 17, 16, 12. That's for existing delivered space. We're not there yet. So for me, it's just, what can I get for it? Can I deliver it for that?
I think the answer is a return, and we can't get a return right now on commercial or retail. And we're not even factoring in the extraordinary, and this will have to come, because we're gonna have to move on to Ethan, to Ben, but, and can be this, we can drill down into it more, and hopefully in next meeting very soon. But about the cost of historic rehabilitation,
I was just asking what profit margin you were looking for, that's all.
a market profit margin.
Not there. Okay, just real quick, as Ben takes over here, thank you, Ethan, I appreciate that. Any other questions for Ethan?
I wanted to thanks, Ethan. A lot of good data in there. I really appreciate you sharing it with us. I know I'm looking forward to looking through it a little bit better. An Al Grassley, council person.
Just
We need placards.
Just in case somebody doesn't know who I am.
So, for Ben's work on this redo, we asked him to look at scenarios. The scenarios are not plans. They're not what we're intending to do or anything else. In fact, we were looking to really reach out across a wide range of things and say, what does this all look like? The base case is what was approved in the preliminary plan. It's just 35,000 square feet of retail on A and B up front here, on parcel A. Parcel B was a 125-room hotel, extended stay at the time. The townhomes at 145, and on parcels C, D, and H, that is this whole parcel, this collection of parcels right here, we had basically almost 300,000 square feet of office. So it's almost entirely office other than that townhome. So we said, what are the other extensions? Let's look at things, because we're going to break it down by type within that. But we said, just give us some scenarios that give us a crazy wide range of options. So two of the options say, well, you know, this is just a ton of office, so let's knock that down and let's have a bunch more residential. Another one has a bunch of residential plus the hotel. The next two scenarios, because we get this question all the time, we're talking to bankers,
The state,
developers, state officials, all kinds of people, including Department of Commerce and people like that, none of the present leadership, but we go in and we start talking about the incredible cost of rehabbing the historic buildings. They say, what if you knock them all down? What if it was new construction? Because new construction is so much less costly than rehabilitation. So we said, okay, well, let's look at that. That's not what we want. Historic is Sykesville's first name. Historic is our middle name. We are Warfield at Historic Sykesville. It's all about preserving these things if we can. We have to figure out how to do it.
I think the important thing is we were asked the question, part of what guided this was we were asked the question by the state.
Multiple times. So you'll see in those scenarios, new construction is demo and new construction to take care of that cost. We think we have a totally different way of doing it that's come up in the last year, but you'll see what those scenarios are. So they're very different mixes, but within those mixes, we're then trying to get to, those of you who know math or engineering, partial derivatives. You know, what's the contribution of this component, this component, this component? So you'll see the overall fiscal and economic impact of those different scenarios. It's all about trying to drop inside that and say, what are the different elements that we can move around to put together an overall plan that's successful? And that's what I hope we get to in the next little bit, is how do we work together to do something that is a contribution to Sykesville, that complements downtown, doesn't parasitize it, but it's a long ways away. It's a mile up the hill. It's very different walking from here to Bex or walking from here to the station as opposed to walking to Warfield. So we're looking for a different dynamic, but these are the scenarios and the components and the fiscal and economic impact of those different scenarios that Ben will talk about.
Thanks, Roger. Mayor, council members, thanks for having us tonight. So we'll start off. There's a lag. All right. We'll talk about fiscal versus impact first, because that's something that a lot of people use interchangeably. We want to make sure that everyone really understands that difference. We'll look at results by land use. We'll move on to a brief description of the scenarios, but then what does the absorption of each scenario look like? Then we'll look at the fiscal impacts to the town, to the county, to the school district. Then we'll move on to the economic impact, so employment generated from either construction or ongoing employment at the site, and then the actual economic output. So, what's the household income? What's generated at businesses? And then we can further this discussion. All right, so fiscal versus economic. Well, let's start off. What is impact analysis? That is money that goes to the town, to the county, to the school district. So it's tax revenues generated, it's expenditures, your police, your fire, the school district. So it's really looking at the government side. So again, revenues generated by the land uses and the expenditures related to those. So when we look at the economic impact, we're really looking at the economy. So what are the what's someone making? So if there's a household, a new household here, well how much? What is their income? They're going to spend some of that in the area. So that really that's induced or indirect impacts to the local economy. Or if you have a business located here, they're spending money in the area. They are paying employees. So it's really looking at going to individuals or businesses when we talk about the economic impact. So the residential impacts. We're really looking at construction and consumer spending. Non-residential, we're looking at the job creation and then the disposable income generated at that site. This doesn't look at just the city, because we know that some people who are working here are going to live in Carroll, out in the county. They're going to live in Howard County. They're going to potentially live in the other surrounding counties, or they live here and they work somewhere else. So we know that you're not going to capture everything. So this really looks at the market in this area, and specifically we were looking at Carroll County economic impact factors. So it does at least tailor it to this area. It's not like we're saying, hey, these are economic impact factors that are applicable to all of Maryland or to the Mid-Atlantic. We're really looking at the county level data. All right. So what can we answer when we do a fiscal or economic impact analysis? Well, we can look at the relationship between, development densities and infrastructure costs. We can say, all right, well, different types of land uses generate surpluses compared to other land uses that may generate deficits. So, what is the best mix of uses, knowing that you do need some sort of, mix to balance your economy. And then, when we look at the actual geographic location, how does that change development costs? And then, what can we do to leverage public dollars for this economic impact? So types of incentives. So, we can look at direct payments from the government. That's one example. Which you would use for redevelopment. You could use a TIF, so tax increment financing. But basically, how do you, as a local government, maximize the return for your investment? And then, the time impacts. Are we living off of tomorrow's growth? So are we saying, hey, the only way that we can balance our budget is to continue growing? So we really want to look at basically what all land uses are contributing and requiring in services. And so what affects a fiscal impact analysis? So we're really looking at a few components. The one I want to start with is actually revenue structure. So depending on where you are in the country, your revenue structure can be very different. So if we're looking at Arizona, where they have point of sale sales tax, then your retail uses are going to generate a lot of revenues compared to your office and industrial, because they're not capturing that sales tax. If you go to Ohio, where they have a local income tax by job location, then because office and industrial pays more, they're going to generate more revenues than retail. So it really depends on where you're located as to what is going to affect the fiscal the most. In Maryland, the way that the tax structure is set up, you're going to get property tax from residential and non-residential. That's not going to change. But on top of that, residential gets the income tax. So it's just set up very favorably in Maryland for residential development to be a surplus provider of revenues, where they're definitely going to offset the costs associated with them. Whereas your retail or office, which are going to generate more vehicle trips, maybe they need more in the way of police or fire or road maintenance, but they're just not generating as much of that revenue. And so we'll get into that a little bit later, where I actually look at what's happening per land use, but they are very different based on where you are, city or county. Sorry, town or county. Another thing is just to look at differences in development. So if you have brand new houses with lots of children, then you're probably going to be generating a lot of property tax, but you're probably going to have a lot of school costs. Whereas, if you have, multifamily, well, you might not have as much property tax, but you may not have as many students. So it's really looking at each land use and making sure that we really understand, what are the cost drivers and what are the revenue drivers associated with that. And then, just infrastructure capacity, life cycle. One thing that we look at in the fiscal impact is, we know that to maintain your existing level of service, you're going to need some more police cars, you're going to need fire apparatus. So, that's something to consider, because if you had excess capacity in your police or fire, then, maybe you wouldn't need that as quickly. But we want to say, hey, this is, sort of the most conservative approach. We want to make sure that you understand that there are capital costs associated with this. All right, so some cautions to fiscal impact analysis. It's a science and an art. You can't just say, hey, this is something that's going to hold true for every single community. So we really need to look at what makes, the town or the county or the school district unique. We want to make sure that we really drill down into those land uses, make sure that we really understand, again, the cost drivers and the revenue drivers. Again, the fiscal impact is only one part of the equation. We want to provide this to you so you can make better informed land use decisions as just a fiscal component. You take it as you will, you are elected officials, but we want to provide you that just so you understand fiscally what's happening with different land uses. And then, better data, better analysis. We want to make sure that, you really understand all of the methodologies, the assumptions. All of this is, in the report. We have recently updated some of the assumptions based on the market components. So there will be an updated version of the report based on that. And then it's really important to look at the total impact. Don't just focus on the revenues. Just say, oh, well, yeah, the residential is going to generate this much revenue. Well, we also want to look at the cost. What does it cost? Okay, well, is it more or less than the revenues? In this case, it's less. So really, your residential development is subsidizing other types of non-residential development. So that's one thing that's important to remember. All right, so the results by land use. So there's a lot of numbers, a ton of numbers, but basically it's saying, hey, this is, the town, the county, Board of Education. The bottom in green, that is the net impact, the average annual impact. So you can see that they're all positive, but when you look just below that, we specifically pulled out the town. Because you're getting a small share of income tax, but your non-residential uses are not generating income tax. That's the big thing to remember. So as I alluded to earlier, retail, gas and convenience, office, those are all negative impacts to the town. Hotel, you do see that it's a 0, but it's slightly negative leaning, and that's because they have again, no income tax. The police calls for service generated by 1,000 square feet of any of these uses exceeds what would be generated by any one residential unit. So again, we're talking about just a higher demand for public safety services from non-residential uses compared to your residential uses. And then vehicle trips generated, so just wear and tear on your roads, things like that. All of the non-residential uses, just 1,000 square feet of any of those is going to generate more vehicle trips than any single residential unit. So again, that's just important to understand that those are really some of your cost drivers. Public safety and vehicle trips generated. So, because those uses are not generating income tax, they are a negative impact to the town.
And I'm sorry it's so impossible to read. This is an important slide. The bottom line for the town is something you should consider, and we'll take it up again in whatever format you want to. But maybe we need to buy you bigger screens.
Or put less information on the screen.
Sorry.
Well, we could have just said residential, big surplus, non-residential, it depends. And really that's what we're trying to get across here, is that really if you're looking at a purely fiscal perspective, then residential pays for itself, non-residential, sometimes it doesn't.
Question in the back.
A quick question. I don't see anywhere on here the impact of employment opportunity on here and the impact that would have on the town.
Can you elaborate on that?
Of jobs, places for people to work, income generated for the town. That doesn't seem to be in here, which would seem to me to be a little bit of a mission.
It's coming up for economic impact.
Right.
Okay.
Yeah, because right now, we're talking about the fiscal impact, so the taxes generated and the expenditures for each land use. All right, so scenarios. What you see at the top left, this is the net impact of each scenario. And bottom right, you can see sort of a comparison of the scenarios. So the base scenario, that is the approved plan. So we're looking at 105 residential units, about 321,000 square feet of non-residential development, and 125 hotel rooms. We move on to scenario 1, it's 527 residential units, 77,000 square feet of non-res. Scenario 2 would be 427 units with 81,000 square feet of non-res and 90 key hotel room. Scenarios 1 and 2, these are rehab. So it's rehabbing this the east side of this site. Then scenarios 3 and 4, those are demo. So with these, we were asked to what does it look like if we actually take down these and build new. So with scenario 3, we're looking at 464 housing units, 49,000 square feet of non-res, 90 hotel rooms, and 178 independent living beds. And then finally, scenario 4, 479 residential units and 83,000 square feet of non-residential. So what you can see is, all of the alternative scenarios.
With 3, 4, and 5 not being an alternative, so we can move on from there. It's not even up for conversation.
Well,
No, it's not up for
Just to be
conversation.
clear, we understand.
It's like, I don't know how to drive, so I'm not going to select buying this car as an option between buying and walking.
Understood,
Like,
just so we
okay.
understand the exercise is that.
The exercise
the
is we
state-
have 5 more minutes to our time.
Okay, when this, just real quick, because when the state started saying, when we started going to them, as we always said we needed to, and the town and the developer were on the same page about this years ago, we would need to go to the state for assistance to save those buildings. And if the state's gonna make an investment in saving those buildings, they wanna know what the ROI, comparative ROI on their invested tax credits or whatever are, and wanna understand the difference between the two. Again, I understand it's not a real option, but that's what we were asked to do, and the data's there so people can interpret it. Not just for you all, but for the state.
Who asked you?
We've talked to the state, we work with DHCD, Commerce, Department of Planning, and we start weighing, okay, that we start saying, look, we need incentives for this. They want to know what's the cost of preservation? What's the ROI? And what's it look like if you don't spend that money? What are the impacts? So if we don't spend $30 million in subsidies to save the building, or $36 million, okay, to save those buildings, okay, what's the ROI versus what's the ROI if we're spending that? So they can, you know what I'm saying? So they're not having to make the investment for those last two. When they
So to be clear, the state asked you to provide these last 3 scenarios.
It's been a question, so we provided the scenario so we could answer the question.
No, scenarios 1 and 2 are both rehabilitation. It's just 3 and 4 that are the demolition. And it started 3 years ago when we did the study with the national consultants, looking at all of the campuses around the state, focused on 3 of them, Warfield being the primary one of those. Many of those consultants, elected officials, appointed officials, lots of people involved in it, in evaluating the effectiveness of catalytic historic renovation tax credit. We're saying, well, what about the alternatives? So that's what the last 2 are, or the knock them down and rebuild something else. Go ahead.
So as you can see, the alternative scenarios, they all have less non-residential development than the base approved scenario. The alternative scenarios were developed, to reflect, better reflect the non-residential demand, the actual market. The county office absorption has been historically flat, so shifting some of those uses from commercial office to other uses. And then, it's just important that the higher cost to rehabilitate the historic properties makes the Warfield offices just more expensive than something developed elsewhere.
Can I just, to cut to the chase, so they're all profits?
All profits.
So it's just that, back to my question of what is your profit margin that you need to get? I mean, you still make money on this.
This is to the town.
I understand, but I'm saying there's still profit across them, right? We're not losing money if we stay with the original
The
scenario.
assumption is that you can build what's proposed there. And we would argue based upon the market data, that even that's if you can build out scenario 1.
Okay, but it's still.
If you can build it out, but.
Right.
And what does that assume in that base scenario? It assumes a 20-year absorption.
Yeah, basically 13,000 square feet per year over 20 years.
This is going to take us into a much more complicated area that I don't think we ought to get into for now. They all contribute. You put $100 million into a community, which is what we're talking about here. Yes, you generate benefits in lots of different ways.
Right.
But the character and the amount is different depending on what goes on.
So again, Jeremiah Sykesville, council member. I said it first this time, that was nice. Have you ruled out any of these scenarios as of yet?
Yes.
And which scenarios have you ruled out?
We've been successful in getting a lot closer to the preservation of the historic buildings. The hotel's out, so the green layer's out. The rest of them are likely to be there in some blend or capacity, but we're not at all interested in scenarios 3 and 4.
Just real quick, Jeremiah, we'll come back and give you a lot more detail on this, but just to be clear, to cut to the punchline on it, based upon pre-COVID numbers, there was a $31 million gap between cost and value on rehabilitating the remaining vacant space in parcel D.
So
It was upside down 31 million, so the cost exceeded the finished value by $31 million. Through the last legislative session, working with our senator, working with DHCD and planning, we were able to identify over $31 million, $36 million gross in potential federal and state incentives to plug that gap. Net of transaction cost, it gets you a little under 30, but we've gotten very close to plugging that gap. So that's what's been going on the past couple of years, 3 legislative sessions. And we will come back and explain that in more detail, because I know we're running out of time. And I know that there was question about economic impact, so I think it's important for you to be able to.
Can we also the school impact?
It's
Yeah,
on- it's on here.
Can you very quick, when you're going through those, please make sure you tell us what the school impact is, because my understanding is we're redistricting if we need to. Is that correct?
So up there on the screen, it does talk about the school impacts in terms of capital and operating expenditures. There would need to be a drill down in the discussion with the kind of the nuts and bolts, for sure, when you start talking about redistricting schools and whatnot, and it will have to be a further discussion, but
it does have that impact, correct?
but it does have the financial impact baked in here, yes.
No, it has the impact of redistricting schools.
No, we're not there yet. We haven't done those projections. That's an additional layer of complexity. It picks up the fiscal impact. So it says, it generates a number of students and then says, and so the money moves this way. But it doesn't answer the question, because we know schools are, particularly elementary and middle school, are at or near capacity.
Correct.
No, we understand that. And that complexity has not yet been answered, but the fiscal side of it is there. Not the other aspects of what does that mean in terms of student bodies and so on, and how does that move?
So what's the source of the number? Maybe you can bottom line. What's the source of, or how do you get to the net fiscal impacts on schools in your analysis?
It's based on enrollment, so there are components from state funding, local funding, federal funding, transfer from the general fund.
But how many pupils are you adding?
Off the top of my head,
We'll get you the backup to it.
yeah, because there are 5 scenarios basically, so and it's going to change for every single one.
We'll get you that. We can get to her that detail though. Okay,
Yeah.
good.
Well, on sheet 8, Lisa, is the results by land use. I'm assuming they got Board of Education there for townhouse stacked. I'm assuming that's like the school taxes that you're gonna get from the townhouses. So that would be the impact on the Board of Education. Fiscal.
Well, right, but my concern is we're already at max, so we're
Yeah.
talking about them building new buildings and redistricting our kids.
I got it. Yep.
Okay. We'll get you the backup data on that and we'll have additional discussion.
All right, I think we've hit on most of this, but really the big thing to think about is on absorption. We're looking at about 13,000 square feet per year for office or commercial in the base scenario, whereas in all the other scenarios we're looking at just 18,000 square feet of office total. That doesn't count the existing rented ground lease that's already there. But really, the big differences are you see hotel in scenarios 2 and 3, and you see independent living in scenario 3. Again, if we're really focusing on the rehab scenarios, then we're really looking at scenarios 1 and 2. So with residential absorption, the base plan was 9 townhouse units per year through 2032. When we look at all the other scenarios, we're looking at essentially double that when we're looking at the townhouses, some of the scenarios add in stacked townhouses. So, scenario 1, for example, we're looking at 9 units per year, so that's 2022 through 2033. With scenarios 1 and 2, we are looking at affordable housing. So that's rehab of those existing historic buildings, and really what you need there is the tax credits to support the rehab of the existing structures.
I have a question. Anna Carter, Town Council President. Just to reiterate and to make a little bit less confusing, when you said multifamily affordable housing, that's low-income housing that scenario 1 and 2 are encompassing. And part of that deficit, Steve, that you were talking about, that deficit between the cost of rehabbing a building and the sale of it, that's where the tax credit comes in with that affordable housing, correct?
Tax credit comes, good question, tax credit comes from 3 places. There are 3 different tax credits that we would access. First one is the federal housing tax credit. Second one, which is around $15 million. The second one is the catalytic revitalization tax credit, which we worked on and for 2 years and just passed in this last session and benefits only campuses. State-owned campuses or formerly state-owned campuses like Warfield or Crownsville or Tone School or Bainbridge. And then the last part of it, we're assuming, I think it's around $6.5 million in federal historic tax credits. So yes, it's that stack plus additional funds from the developer and probably tax exempt bond financing to make it happen.
And
So
that's
2 of the
only,
elements are independent housing, federal historic tax credits and state historic tax credits, about 20% and 40%. The other 40% would be related to housing, workforce housing, working, middle class, $30,000, $40,000, $50,000, $60,000 a year kind of income. So that's what the affordable housing component is. It's not poor people, Section 8. You got to be working, high credit score, all those kinds of things.
and you said about 40% of your tax credits come from that.
No, filling the gap to save the historic buildings on parcel D is about 40, 40, 20, round numbers. Well, this is subject for another session.
Correct.
We'll stack that up for you, take you through the details and how they all work.
40%, about there.
Correct.
Thank you.
All right, so we'll look at quickly some of the cost drivers. Vehicle trips, as you can see that all the alternative scenarios generate fewer vehicle trips than the base scenario. So, things like, maintenance.
There's a long line here, guys. There it is, okay, it's on that side, but.
Oh, wait a second.
There we go, okay, all right.
Next up, public safety calls. The alternative scenarios are going to generate increased calls, but we have accounted for all of those additional costs in the analysis, and the fiscal impact is still positive for all those residential uses. So now we move into the individual impacts. So to the town, the greatest impact comes from scenario 1. So that's one of the rehab scenarios. And over the 20 years, the cumulative impact is about $7.2 million to the town, or about an average of $361,000 per year. You can see that the base scenario, the impact is less than $3 million. So again, all of the alternative scenarios are generating about double the net fiscal impact compared to the base scenario. To the county, scenarios 3 and 4 are generating the greatest impact. That is related to income tax because there are a lot of housing units, a lot more housing units in all the alternative scenarios, but specifically in scenarios 3 and 4 when we're looking at the townhouses and market rate. That's why those are generating so much a greater surplus. It is important to point out that sorry, skipping ahead, for Board of Education, it's important to point out that all of these are going to generate a positive impact to the Board of Education. But the overall surplus to the school district is, again, much higher when we're looking at the alternative scenarios. And then cumulative impact, essentially the impacts to scenarios 1, 3, and 4 are the same. They're all within about $1 million of each other. But we do want to again point out that the base scenario's impact is about half of most of the other scenarios. Scenario 1 is going to generate the most revenue, but it also generates the most expenditures. That's because it has the most housing units, it has the most students. So it's going to have, again, the most revenues, but also the most expenditures. And then, scenario 3 has the greatest impact. It generates less revenue than scenario 1, but it also generates less expenditures. Now, economic impact. So this looks at employment. The left side is going to be generated from construction. So that's why you see it dip down at the end, because you've essentially finished construction towards the end of this 20-year time frame. And so, we don't count construction as a recurring source. We look at just that project. When it ends, so does that employment. And so that's why you see a lot more construction employment in the first 5 to 10 years, because that's when they're doing all the building. It tapers off. On the right side, the ongoing employment, this is employment at the site. So the base scenario, you see by 2039, it generates the most jobs, but that assumes that you actually absorb all of that square footage. If you don't absorb it, then the ongoing employment, the impact from the base scenario is much less. And then the actual output, so wages, business spending, again, when we're looking at construction, it starts to taper off. That's on the left side. The right side is the ongoing, so household spending and employment at the site. Again, if you don't absorb the non-residential component of the base scenario, then the base scenario is going to have a much lower economic impact. All right, and then just to sum it up, the base scenario again is the existing approved plan that has the lowest fiscal impact and the highest economic impact. That is dependent on the office market. Scenario 1, rehab and additional retail, high cumulative impact, moderate economic impact. Scenario 2, rehab, additional residential and hotel, moderate impact for fiscal and for economic. Scenario 3 would be demo with additional residential, hotel, and independent living. So that has the greatest cumulative impact and it has a very high economic impact. And then scenario 4, demo and then additional residential, high cumulative impact but a moderate economic impact. All right.
Phil, to go back to what you had brought up, and if you take the intersection of what Ethan spoke about in terms of historic job growth being well under 1%, and we look at well under 1%, but we also talked about the fact that also in the commercial market, we haven't added a lot of office space. Haven't added a lot of office space because there hasn't been a lot of employment growth. That transcends what any one project can do. Build it and they will come is not a, right, it doesn't work for us. It's a theoretical exercise. If you could get that, you see what the job impact is.
If it's built out on the base scenario, there's good.
The question is, what are the drivers to actually make that reality happen? And that, I would only say that transcends one project, and certainly what one developer can do. Just, you know what I'm saying? There's a lot of space in the county, a lot of ground to build new ground up commercial development. And I think we have to get back to the basic question of why hasn't that happened, and is it reasonable to assume that we're suddenly going to be creating thousands of jobs over the next 20 years to build out that space, and that we're gonna be able to compete on the basis of cost.
I hear what you said.
And so, but I hope that answered, I want to circle back, I hope that answered it, and if there's additional information after looking at the materials, we can get
Those
to that.
graphs were informative.
Okay, good.
Any other questions for Ben at this point? And again, follow-up questions are great because there's so much detail and you can't read half of it or 90% of it.
Right.
So by all means, we'll engage that. None of these are plans. So there's still many studies to be done. Engineering, feasibility, soils, schools, traffic. I mean, there are a whole lot of other things that have to be wrapped into it. So we're not able to answer every question tonight. All we're trying to get to is some of the basic ingredients, some of the opportunities and challenges, which we'll go into in a lot more detail in the next session, to be able to talk about what the impediments are of these different components and how they might be blended into something that works for everybody and that's a wonderful, sparkling, something to be proud of for the town.
Can I just ask a quick yes or no? While you're doing all these plans, time is ticking on those buildings. Are you actively managing them so they don't decay during the research period?
I'm sorry?
Are you actively doing anything with the historic buildings to make sure
Yes.
they do not decay
I've got
during the
hundreds-
research?
I've got hundreds
process?
of thousands of dollars in rehabbing those buildings. I'm already
That's active.
active, yes. I mean, we
The
have,
roofs are, for instance, are inspected annually, okay, and repairs are made. I don't remember what the last bill was last year.
It was just a yes or no.
Okay, but yes, but the longer they sit there, the harder it gets.
So,
And the more expensive it gets.
so I guess I have a follow-on to Councilwoman Garoff's question, Jeremiah Schofield. You had mentioned something in your opening about spending $14 million on the project so far. Is that something that you could share with us, how you can break that
not in
down?
this kind of a session.
Not-
That's outlined, but I'm happy to go into that, but it's got to be a more protected situation. There are many, many elements that we'd like to talk to you about, that we started trying to find the right format to do that, starting 2 years ago, when it was clear that we had some gigantic issues that drain capital from the project. Regardless of what we do together, there are just some structural elements that are drains. So in the right ceremony, we're happy to go through all that, yeah.
It's contractual issues and financial
Understood.
issues related to the partnership, kind of a closed session issue for us.
I understand
Yeah.
the proclivities to doing it here. I was just wondering whether or not you'd be able to share
Yes.
what the cost outlays have been so far,
Yeah,
so that we have a better understanding of what you have been doing.
yes.
Anyone else?
No.
Okay, great. Thank you guys for your time.
Thank you for your patience, everybody. I'm
Sure.
Sorry for the squint and the length and everything else, so.
I wished I would have had more than 45 minutes when I found the email that I received at 5 PM to review this prior to this evening's meeting. That would have been helpful.
I didn't get it, so.
And, but I also want to thank staff for preparing the room so that we could have this meeting this evening for the first time so well.
Yeah, it's our first time back. Yep. I'm by the townhouse when I go.
Yeah, very good. Thank you.
Thank you, everyone.
Thank you.
Be a person. I'll probably take 2 or 3 a day.